Accounting convention. What is accounting convention? Accounting convention are guidelines used to prepare financial statements of companies slash entities in the absence of accounting principle. What does this mean? Where there's no principles to prepare financial statements, guidelines are used in preparing the financial statement. There are 3 accounting conventions that we'll be looking at. One is known as Prudency or Conservatism Convention. The second convention is known as Materiality Convention. And the last convention is known as Consistency Convention. We'll be looking at these 3 conventions. What did they mean? And what's their impact in preparing financial statements? The first accounting convention we are looking at is Prudency Convention. What is Prudency Convention? Prudency Convention stated that revenue should not be overstated and expenses should not be understated. What does this mean? It means that when preparing financial statements, revenue are not to be overstated from the reality, and expenses are not to be understated. For instance, if in 2020 sales amounted to 10,000 naira and expenses for the same period amounted to 8,000 naira, it means the company has made a profit of 2,000 naira. But for the purpose of obtaining loan from banks, the accountant was asked to overstate the revenue and understate the expenses. With this, the accountant decided to turn the 10,000 to 10 million naira, which is not the realistic of the company, and also change the expenses to 800 naira, and now reporting a profit of 9,999,200 naira. If this kind of company want to obtain a loan of just 15 million, based on this financial statement, financial institution will grant a loan of 15 million, not knowing that in reality, this company only has a profit of 2,000 naira. In that case, the accountant who have fraudulently overstated the revenue to 10 million and also understate the expenses from 8,000 to 800 has contradict the Prudency Convention, which in practice can lead to 5 years imprisonment and also payment of fine. In that case, This convention is a guide to accountants that revenue are not to be overstated and expenses are not to be understated in order to show the true and fair view of the financial statement of companies. In summary, Prudency Conventions is telling us that both revenue and expenses should not be overstated and understated in order to show the true picture of the company financial statement. The second accounting convention we'll be looking at is known as Materiality Convention. And what is Materiality Convention? Materiality Convention stated that only material items are to be recognized in the financial statement. Only material items are to be recognized in the financial statement. Now, what does this mean? What it means is that only items that are of material in nature to the financial statement should be recorded. Now, to get clearer picture of what Materiality Convention is saying, what Materiality Convention is saying is this: items of small values should be lumped together, before it is recognized in the financial statement. Before it is recognized in the financial statement. What does this mean? It means that item of small value, such as biro, pencil, ruler, should not be recorded individually because of their value are very small. In order to make it material and to have a very recognized value in the financial statement, this item can be lumped together and recorded as stationary account. In that case, what we are saying is this: if an item is of small value, the materiality may affect the financial statement. In that case, for such item to be of material, they can be lumped together and recorded as an item with a bigger value. That's why sometimes we keep record like land and building instead of recording land separately and recording building separately. But the argument under Materiality Convention is that an item that is of value to one company may not be of value to another company. For instance, in a company that has 50 billion capital, 100 naira may not be of material to such company. But a company that is capital base is 10,000 naira, 100 naira will be of material to such company. That's why we concluded that what we can say, if what a materiality depend on is on the size of the organization. The item to record as material depend on the size of the organization and the capital base of the organization. But in summary, Materiality Convention simply means items of small value should be lumped together before they are being recorded in the financial statement. The last accounting convention we'll be looking at is is Consistency Convention. Consistency Convention. Now, what does this Consistency Convention, what does it mean? Consistency Convention is saying that any policy, any accounting policy that have been adopted, in preparing financial statements, should be used for reasonable number of years. For reasonable number of what? Years. What this one is trying to say is this: for any policy accountant has adopted in preparing financial statement, it should be used consistently for reasonable number of years. Which means that if there are two different ways of preparing a particular item in accounting, if the accountant have decided to choose the first one for 2018, he can't choose the second one for 2019. He has to be consistent with the first policy he has chosen for a reasonable number of years. And if he's to change it, he has to explain to the management the reason behind the change from one accounting policy to another policy, which means that this is a very good guideline for accountants in order to show that transparency in preparing financial statement. Because if accountants start changing accounting policy year in, year out, it can be a signal of fraud to the shareholders of that company. For example, we have different methods under depreciation. We have straight line method, reducing balancing method, sum of the year digit. Now, if accountants have decided to use straight line method in preparing depreciation, what it means is that the accountant must use the depreciation in the first year, second year, third year based on straight line method. It cannot decide to use straight line method in 2024, and in 2025, it will now shift to reducing balancing method. In 2026, it will now choose to use sum of the year digit. This may create a signal to the shareholder that the accountant is trying to manipulate the financial statement to his own advantage. Based on consistency concept, if a particular method has been chosen, the method should be used for a reasonable number of years in line with consistency convention. We'll be rounding up the class for today. Like our YouTube page, subscribe to it in order to get more knowledge. Thank you.